Hi everyone, hope you're all doing well, and today we're going to talk about some of the UK stocks that have crashed recently and the share price has fallen off a cliff because some of them have gone quite down. And yeah, I think the main one that was asked for was National Express, so I'm going to cover that one to start with, and a few other ones as well. But a few of you guys asked for National Express, but there's also been a few other ones mentioned, and I thought, you know what, best thing to do is cover them all in one big massive video, spend a minute or two on them, and hopefully you guys that have been asking for a lot of these UK companies, I kind of cover them all in this video here for you guys, so I hope it is useful. Sorry there was no video yesterday, I'll be honest, I recorded one, but it was quite late at night and I was too tired. I watched it back and went, yep, not good enough, I'm too tired, so I thought, you know what, let's re-record it this morning and then get it up for you guys. So apologies for that, but I don't want to put like half decent content out for you guys. I want to make sure it's, you know, good content for you anyway. So hope that was all okay, and if you could smash the like button if you're new, subscribe, that'd be absolutely amazing. So starting off with National Express, because this is definitely the one that was asked the most about over the last kind of few days, because obviously this one has been dipping quite a bit recently. So if you look here, this is April time. It's had a bit of a pullback. It was down about 26%. It's actually having a pretty decent morning actually of recording this video. This was always the weird one because this was a bit like a Greg situation. We had like the initial CV dip, and then it actually put in like a 133, and then it put a little bit of a bounce in, and then we got round to like summertime, and then it went back down again, back to its CV lows. Greg's was very similar to this, and then it's had a very good recovery since then. The stock's currently up like 135% or something like that. I think I'm up like 70% on this one, and then recently, boom, we've had a bit of a fall off the share price a little bit again. And I think with a lot of these companies, it's just the people are getting a little bit worried about cases rising, and it's slowing down the progress of like National Express and a lot of the travel stocks, because I think we were kind of thinking, oh, by the time we get into 2021, and I was thinking it as well, that we would have a little bit of normality starting to creep in, and a lot of these travel stocks would go and do okay, but we are getting a lot of normality, but the big thing that's still getting held back is a lot of these travel stocks like in National Express, and that's what's getting hurt. So yeah, because of that little fear that what we thought was going to be now a recovery for National Express isn't really happening, it'll probably get delayed a little bit. So I guess with this little dip, what you've got to think about, we're on a 21% dip here, even from, if we go pre when all this CV stuff were happening, we're still down like half the share price. You've got to look at this dip and think, is this now a time to go buy? And if you think like, oh, we're still not out of the woods with a lot of these cases and everything like this, and it will be a long time before National Express recovers, then you're probably not going to buy it. But if you think that this is probably a short-term thing, maybe for the next 12 months, maybe this is a buying opportunity, because when you look at this company 2, 3, 4, 5 years down the line, do you think it's a good opportunity to go buy it on this dip? And the big thing with National Express is, if we go on the recent trading update, the big thing that you get with National Express compared to a lot of travel stocks, like an airline, a lot of them are leisure, where National Express is like a essential. These guys operate a lot of lines that are for getting to work, going to school. So for these guys, a lot of their services are still operating. The big thing is like the couple of extra services they offer, like holidays and needing more people to travel. That's still getting hurt a little bit, a bit of freedom between countries, moving around. That's still going to get hurt, but they still have a lot of essential work that's going to happen. So if you went on the recent trading update, which is 12th of May, you'll see that actually it's not too bad. We continue to generate positive EBITDA, slightly ahead of our base case, with positive underlying operating profit delivered in March and April. So you can see here, these guys are, not burning through the money that much, and that's a big thing compared to a lot of travel stocks. A lot of them, like airlines, they're still going to carry on burning through the cash pile. National Express, you don't need to worry about that, because they're not burning through that much cash, because they have the essential kind of travel that is needed for them to still operate. And from there, there's numbers that are easy for them to beat, and as the world kind of opens up again over the next 1, 2, 3, 4, 5 years, the company should do okay. And don't forget, this company was, before the CV happened, January, February 2020, these guys, if you look at their earnings report, they were absolutely smashing it. I think their revenue was up like 17%, and previously this company has been a very good company. So from my point of view, I think like this is actually one of the best travel stocks to buy, because you're not having to worry about them burning through cash, because they're near break even, which is good, and because they have that essential work, they won't burn through that cash. And as more restrictions go and more travel happens, you'll just see them easily beating numbers and the company doing quite well, and the share price is massively beaten down. Because I'm going to talk about Jet2 in a few minutes, and if you look at their share price, Jet2 is like actually getting like near kind of pre-CV numbers, and this one is still massively off it. And I think when you compare the share price and then you look at National Express, this is massively off it and Jet2 is near it. I think this is a great opportunity. So I think the thing here is you got to look at this company and you got to look at 1, 2, 3, 4, 5 years down the line. If you're a long-term investor, do you reckon National Express is going to stay here, or do you think they're going to get back to performing very well like how they were doing? And my money would be back to where they're performing. So yeah, I think this is in the short term presenting a very nice dip to go buy. Personally, for me, I don't know if I'll buy just yet. I think it needs to go lower for me to buy, because I already have a good position built out with a very good average. So it would need to go a bit lower for me to actually consider buying them. But if I was on the sidelines and I was looking for like a UK company that is a bit of a beaten down company that's a great company, I would definitely be considering this, because in the next 2, 3, 4, 5 years, I can only see this company going back to where it was with really good profit and revenue growth, and I don't need to worry about the balance sheet because of the essential work that it was still bringing money for the company compared to a lot of the airlines. So yeah, National Express really, I'm quite happy with this one, and I think this is a really good opportunity if I was on the sidelines. But that's where I'm at with everything with National Express. So I hope that covers that one for you guys that were asking about that one. Next up, Boohoo. So I got getting a few questions about Boohoo because we entered the year actually doing very well, and then since then it's just fallen 23% down a fair bit. And the big thing that I kind of went in here is like, for me, Boohoo's performing very well on revenue and profit, and that's what I want to see. As long as the company's performing revenue and profit, that's the main thing for me, and the share price should follow. And it looked like it was going to happen, and it hasn't happened. It's fallen off a cliff, and I think the one thing that kind of is affecting this company is the negative press that it has. And really this year, it hasn't had that much, which is good. The big thing that I was looking at that was worrying me is like, if they carry on with negative press, is this going to hold the share price back? Realistically, there hasn't been that much negative press. There's been one or two articles thrown about here, there and everywhere, but you're always going to have that with a lot of companies, and especially with a company like Boohoo, which the media love to talk about. It brings in a lot of viewers. You're always going to have that happen with a company like this, but I'm just kind of thinking that if it reduces the amount of massive negative press, then we should do okay. But it's kind of fallen down a little bit. It's had its typical thing where it's gone into earnings. If we look at where it was about earnings time, it didn't really pull back too much. It was only down 10%. But it's done its normal thing of like actually falling off a cliff after earnings. And as well as that, in here, what's caused this big drop here is actually another company. Asos has caused this company to actually fall off so much recently. Asos basically came out, and we'll talk about them in a second, Asos, but they came out and blamed, they came out and said their guidance is weak, and they're struggling for growth, blamed it on CV, blamed it on weather, which we'll talk about in a little bit. Because Asos brought out weak guidance, people thought, it's going to be the same for Boohoo, and Boohoo sold off as well. But when we had Boohoo earnings, they actually said that everything's going okay. If we look at the recent trading update here, the guidance here is for 25% sales growth. They actually in the recent quarter brought out 32%, so they're still ahead of expectations halfway through the year, which is really good. And everything seemed fine with Boohoo, but because Asos brought out weak guidance, it affected Boohoo. And maybe because Asos was a little bit later, maybe Boohoo didn't really realise like it's slowing down, we don't know. But for everything we could see with Boohoo, it seems okay at the moment, and it was strange that it got punished because of another company. So it's a little bit of a buying opportunity. I wouldn't mind if this company kind of goes to the 250 range, that's where you'll see me buying. But it's not a bad dip, and for once I'm not kind of saying that it's actually Boohoo's fault. It's actually someone else's fault while this share price is going down. And I get people saying, I'm getting fed up with Boohoo at the moment, but this is part of the game. Stocks are going to go down, stocks are going to go up, and this is the reason. It is a volatile stock, and it is the reason why when this company kind of peaks up at this range, I normally do take a little bit of profit off it, because it is a bit of a volatile stock. But if it does go down a little bit more, I won't mind buying, because at the moment I can't really blame Boohoo for anything, because they're performing on revenue and profit, and they're doing the one thing that I asked of them to do this year, which is to avoid the headlines, which they're mostly done. So yeah, I think this is very unfair on Boohoo, and I'm watching this one very close because I might buy some. I just want it to go a little lower if I can, but yeah, I'm very happy at the moment because they're smashing it. So that's really Boohoo, which leads on to guess the next one, which caused the dip, which is Asos. So if you look at these guys, Asos, it's been a very rough kind of year really for Asos. They're down, about 31%, and yeah, since they brought the earnings out, down 24%. But this is a volatile stock as well. Actually, if we can zoom out, you can see here that this company has historically a lot of swings in the share price. A little bit cheaper than Boohoo, but it doesn't grow as fast as Boohoo. But yeah, these guys, they had really good earnings, to be fair, 27% growth. UK sales were pretty strong. They're even growing a bit quicker in EU than actually Boohoo. The US sales are a little bit weaker than Boohoo, but this is what kind of spooks them. Trading in the last 3 weeks of the period was more muted. So this was obviously July, so you're kind of going back to them. And like I said, there wasn't anything in Boohoo, so it just seems like it's something to do with Asos. If I went through the full earnings report, I could probably find out the reasons why. But they basically, as continued CV uncertainty and the weather, which I was like, that's bonkers. So first of all, yeah, I'm not sure about CV uncertainty. Like, sure, like the lockdown kind of got moved back, but I don't think it would affect sales that much. There's still plenty of things for people to go do. So I kind of thought that was a get out of jail card, and I believe that one as well. Like the weather, I don't know about you guys, but literally like every time I've been recording videos over the last month, 2 months, you've seen me. I work outside a fair bit, and I'm like bright red like a lobster. My nose is like glowing like I'm like Rudolph, and the weather's been pretty good. So I feel like management here are kind of like, if Boohoo came out with something very similar, I'd been like, fair enough. But because Boohoo haven't done something very similar, it seems to me there's something going on here with Asos rather than the whole industry. So if I went through the full kind of earnings, maybe I find something, but bit of a weird one for me. So I don't know. And I'm not really considered buying Asos just yet because I kind of have shares in Boohoo, which I think is the better company. So yeah, I feel like there's something going on here with Asos, but basically this is what caused the drop in Boohoo anyway, so I thought I'd cover that one. Now the next one isn't negative, it's a positive. Sumo Group, it's sad to see another UK gaming company. We don't have many great UK growth companies, but Sumo is one of them, and I actually really considered buying this in February time. I didn't in the end. I think the valuation was just a little bit too much for me, but yeah, it turns out maybe I could have done, was it February? I think it was about this point here. Maybe I should have bought because, yeah, I would have made a nice 38%, but hey, you can, everything's always easier in hindsight, I guess. But yeah, a little bit sad, I thought I'd just mention it. It's not crashing like the ones, like the share price has fallen off a cliff. This is actually doing really well, but I thought I'd just mention it. Just sad to see another UK gaming company go off the scene. We had this one, we had Codemasters go. A little bit sad to see some great UK companies going off the scene, and the one thing I was frustrated about is that this was bought by Tencent, and as we know, Tencent tried to merge Douyu and Huya, and they kind of got, oh no, anti-monopoly, that can't happen. But 1 week later, oh yeah, go buy yourself another gaming company out there. I mean, it's weird, isn't it? That was the one thing that kind of frustrated me, but I just thought I'd mention that we are losing another UK gaming company that's a great stock, and yeah, well done if you hold some shares in this one. I've seen a few guys actually hold some shares in this one. I liked it. The big thing for me was obviously the valuation, but yeah, 1.3 billion deal, or dollars, in dollars should I say. So yeah, pretty good if you were holding that one. Jet2, yeah, like I said, compare this to National Express, it's not as down as this has had a pretty decent recovery, whereas National Express has kind of slumped a little bit more. I guess you're still getting it on a little bit of a dip, I guess. But yeah, this is kind of one that will get hurt a lot more than National Express because it's airlines, and this is definitely getting hurt a lot bit. But once again, just kind of comes down to where you think airlines are going to be in the next kind of 2, 3, 4, 5 years. If you think they're going to recover, then this is probably a good dip to buy. If you think there's still going to be a lot of problems further down the line, probably not one to buy. Personally for me, it has to go lower for me to buy this one once again. But if I wasn't in the company and I sold it for a bit of profit, maybe I bought down here and I made a bit of profit, I'd be considering buying this one on the dip. But yeah, another one, it's another one of these, they're getting hurt by the fears of the cases increasing, I guess. Card Factory, this has been an awful kind of few months for this company. Down 41%. I'm still up on this. This is one that I am actually considering buying compared to like National Express and Jet2. For me personally, I want them to go down a little bit lower. I am considering buying some more Card Factory because I think that this should be easy, £1 above the company. It is high risk. The balance sheet is the problem why it's going down here. You look at earnings, it's gone down since earnings because it got spooked because of the financial terms of the loan they got, and it had to get the loan to continue, and I think they'll be okay. We'll look at the recent earnings. They said they're 2% down, and that was with some key events missed. And yeah, I think that for me, I still don't want to make it a big position because I think it has that high risk side to it, but it's one that I'm considering buying because I think that we're kind of nearly out there now. I can't see Card Factory ever get to a point where it has to shut down again, and I'm considering this one. It's one that I'm watching. A little bit of a mention of best of the best. Looks like it's consolidating now. It was always going to be a rough couple of months as it kind of levels out from that crazy growth it had with CV numbers to going back down to normality. It's settling around about 13p ratio, which I think is still dirt cheap. And got to realise this is going to be a long period of where it's going to just consolidate for a little bit. And as it consolidates over the next few months, I'll continue buying. And I think this is a great company at 13p ratio for sure. Not a crash like the other ones, but Card Factory is pulling back a slight little bit. It is a 33p ratio. I would like it to drop into the 20s. Thought I'd mention it. It's not crashing stock like the other ones, but it is starting to show a little bit of a dip here, so I'm watching this one closely. If it does go a little bit lower, I would like to buy a few more shares in this one, so I thought I'd put that onto your list just to keep an eye on, and it's one that I'm keeping an eye on as well. But yeah, needs to go a little bit lower for me, this one anyway. But yeah, hope you enjoyed it anyway. Hopefully that covered a few stocks that you wanted me to talk about, especially the National Express, because that's the one that got shouted out the most, I guess. But yeah, let me know if you've been buying any UK companies you've got an eye on. That'll be absolutely amazing in the comment section. Smash the like button. If you're new, subscribe. If you do want to start investing, some links to some brokers in the description. You join through there, you get a free share as well, especially on the free trade and the stake one. But yeah, see you in the next video.